Okay, so here's the answer to the question in the group. How do you raise your deposit for buy to lets if you don't want to keep just saving up for a deposit? So there are multiple things that you can do. I'm going to give you some examples. Of course, I'm a spreadsheet lover, so everything that I do, I run off spreadsheets. I don't have to be anywhere in person that way. So let me show you. So, number one, the very first thing that I do if I don't have the money in the bank is I have a look at all of my other properties and I see when the property is coming up to the end of its fixed term. I look at if I can remortgage the property. So, if the property purchase price was 200,000, say, and I think that the value is now 320, although that might be a bit high. So, say the purchase price was the market value now is 250. I may be able to take 37,500 out of that property. Then what I do with the spreadsheet is I have a look at actually what difference is that going to make to me having the extra borrowing. So I look at now the value of the property would be 250, so I'd have a mortgage for 250. My capital in would be 62500. My monthly borrowed or my mortgage would be 187,500, and then I just go through my mortgage interest payments depending on how much I think the remortgage will be. Usually for a limited company you're getting it at around 3.5% interest rate. That's quite high. If I was doing one in my own name at the moment, I'd think it would be about 2.15. Then I just look and see what my net profit per month is. Does that still make sense with the remortgage? Or now does it make this deal completely unviable? In which case you may need to mess around here with the deposit and how much money you were taking out. But I always do this first, because if I have money to be taken out of a property I can remortgage, then that is the first place I will start. The second thing I would do if I haven't got any mortgage fixed terms coming to an end, I would look at an additional borrowing analysis, which is possible where, say, your property has gone up in value. You could get in contact with your bank or another lender, depending on what your broker says. So you have to be working with a really good mortgage broker, and you could extend your borrowing on a property up to about 75% of loan to value. I know some people can do it more, but in my experience, the interest rates go through the roof and it's not necessarily worth it. So then I use my additional borrowing analysis, which basically works out how much additional borrowing I can get on a property. So for example here, if I'd have bought the property for £200,000, I'd put £50,000 into the property, and that meant that I borrowed £150,000. But then the property has gone up to £250,000. It now means that I've got £100,000 equity in the property. So I just change this around. And then what I calculate is that based upon a 75% loan to value, I could potentially take out another 37,500. And then I work out how much is that monthly interest going to cost me on that extra 37,500. I always go worst case scenario. Here I've put it at 5.5%. Chances are you get it cheaper. And then I work out how much is my net profit going to be now, based upon the fact that I also have to pay that extra £171.88 per month. If this figure here still looks good, so it would be £351 after I've taken that additional borrowing, then I'd be like, okay, yeah, that works, because once this property comes to the end of its fixed term, you remortgage it all out and you put everything back onto one product rather than having your original mortgage plus the additional borrowing. So that's number two, and I'd see if I could get any money out of that. Next up, we come to option number three, which is personally something I rely on more than I do the other two. Yes, I always see if there's any remortgages that I can do, maybe if there's additional borrowing, although I don't quite like to do that because I tend to get much higher interest rates. I then do an investor analysis and see if one of my investors would want to invest in this. And the way that I do it with my investors is I look for market value and see what market value is today, and then I negotiate a discount on the purchase price. And then what I assume is that when I do my remortgage, I get a chunk of cash out. I'm going to be repaying the investor with that, using that chunk of cash. And then throughout the term, however long, whether it's 6 months, 2 years, 5 years, whatever you want to do, you can then figure out what interest you're paying them. I pay interest on a monthly basis, actually, out of the net profit that I'm earning from my property. That's how I do it. It seems to be quite straightforward. Investors like it because they can just see this spreadsheet and they can see the fact that I know what market value is based upon the fact I've gone out and found comparables. So I'm sure that in today's date, this is how much the property is worth. I go and do some great negotiate down. You might have to go to multiple properties to do this, but then say I bought this property at £250,000, but market value today is £300,000. I know that on remortgage to £300,000, I could take out £37,500. So then I would borrow £37,500 from an investor, and then I would need to put £37,170 into the deal. Of course, the cheaper I get it, so say here, I change this to £200,000, then it says money you need to put into the deal minus £15,000. So you can literally just play around with this. I'm going to give you a link to this investor part of the spreadsheet so you can play around with it yourself. I put a 5-minute training. You just have a look. You can give this a go. But this works really, really well. And then of course, if you need to, so if I put this back to £250,000, if then I needed to find the 37,170, I can always go back to the additional borrowing analysis or the remortgage analysis as well. So it's as simple as that. And I'm doing all of these things without having to do any refurbishment or anything. I'm not betting my bottom dollar on refurbishment. I'm literally doing it based upon a deal analysis. Now, you could also do it where you to add the value, you do a refurbishment and then that brings it up to the new value. That's what you want to do if you're not prepared to negotiate a discount. So you could also in here put a refurbishment of £20,000 if that's what you're going to do, if that's what you're betting on. You now see that money you need to put into the deal. You could bridge that if that's something you wanted to do, if you could borrow the development finance. I have before used 0% credit card finance because I know that I can pay that back really quickly once I get it let out. It works very well when you are doing high net income properties. Like before the pandemic, it was working very well on serviced accommodation. So that was what I was doing to fund the development after I'd borrowed for the properties that I was buying. I would then buy the property, take out the 0% credit card loan, do the properties up on the 0%, get them let out, very quickly pay back the 0% credit card, remortgage out of them, pay back the investor, go again. So actually, I don't necessarily need to put any of my money into the deal. You can do the same with bridging as well, which I can show you here. So say you bought the property for £150,000, you put your legal fees in, your refurbishment costs of £30,000 here, bridging, lending and survey fees. This really varies depending on the bridging lender. Then what you can look at is how much you're borrowing. I've assumed here that you're bridging for 75%. Remember, you've got the arrangement fee, bridging loan hold time. You always should really add an extra 3 months than you think it's going to be, especially in uncertain climates. Cost of the bridging per month, I put 2% here, but that's quite high. You probably get it for cheaper than that. I've then got the cost of the bridging for time, so that's going to be 13,500 over the 6 months. Now, you do have to realise that a bridging lender may deduct that from the amount that they lend to you up front, so just be very aware of that. And then the total to repay on mortgage is 128,250. Then I've got the value after development, so the gross development value of £250,000. All you need to keep in the deal is 62,500, so you can pull out 187,500, which means that total to repay on remortgage is 128,250, which gives you a profit of 59,250. That's actually quite extreme. You're probably going to be looking at maybe 190,000 if you can increase the value like that. Potentially. There you go. So 190,000, you leave 47,500 in the deal. You've borrowed 142,500, which means that you make 14,250. Again, I prefer remortgage, additional borrowing, or investor just purely because I find bridging can be more tricky, and it's easier if you can do the deal yourself, but there's plenty of bridging lenders out there who would do this for you as well. But you would have to come up with a deposit up front. So then you do need to go back to either getting investor lending, additional borrowing, or go to your remortgage. The potential to do 100% is possible. There are banks who will lend 100%, but they take a second charge over another one of your properties up to the 25% of the bank of the lending that you're getting. Banks like Aldermore were doing it. Whether they're doing this side of COVID, because lending is so slow right now in comparison to what was like before, that's something that you need to discuss with them. It may not be possible right now due to the uncertainty in the market, but potentially we'll get back there. Okay, so those are my top three. So go and have a look if you can remortgage. See if you can take out additional borrowing against one of your properties if you've increased the value. You can look at investor lending. Again, that's one of my favourites, and you don't just have to get investor lending from one source. You can go across different sources. I before have taken out short-term lending from an investor for like 2 months just to get me across the gap where I can remortgage in a couple of months' time, but I couldn't do it today. And I've taken out longer investor loans as well. And then, of course, you've got bridging loans, but bridging loans you still need a deposit for in most cases. The other thing that there's a lot of talk about is gifted deposits. This works really well if a really close friend or family member is selling you a property, and in the sale of the property they can gift you the deposit so that you don't need it. So that adjusts on the completion statement. So for example, say a property is worth £300,000 and your parents are selling it to you and you buy it off of them for £250,000, you can use that £50,000 for a deposit as a gifted equity. Some lenders are doing that. That could work really well. Doesn't work so well if you have no idea who the seller is, because the bank's like, well, why would they give you £50,000? But it's an option if you know the person. So again, those are some examples of how you might not necessarily always need to save up for a deposit, and you can keep using your money, other people's money. It's all in the deal, right? If the deal stacks up and you've got that difference between the purchase price and the market value, that is where you're making that money. So you've got options available to you to go and borrow that from elsewhere. And that's essentially how it works. I will put the link to that spreadsheet for you to have a play around with as well. Any questions, put it in the comments below. I'll keep answering.